right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Equity Group and Appleman Properties. We're pleased today to have Travis Watts join us. He's a renowned full-time investor and passive income advocate, serves as the Director of Investor Education at Ashcroft Capital, focused on guiding hands-off real estate investors. Travis's outstanding industry contributions have earned him the Linda's Legacy Industry Impact Award in 2022. Travis, we appreciate you coming on today. Please let the listeners know a little bit more about yourself.
Josh, thanks so much for the invite, man. Love the name of your show. And without a doubt, man, it does require a little bit of a hustle in this industry. Yeah. So for me, that hustle started in 2009 with single family homes. Got into real estate like a lot of people have, and just thought, well, maybe I'll flip some homes or do some vacation rental stuff, or maybe just have some buy and holds. I tried a lot of strategies, and this was all while having a very busy W-2 job for many years. So I gave that about 6.5 years, and frankly, I just burned out. It was just too much to handle, too much to self-manage. So in 2015, I found out about real estate syndications or private placements. And there was a couple guys out of a group in Boulder, Colorado. It was like a real estate meetup group, a fairly substantial one. And they had been doing this limited partnership investing in syndications for almost 20 years. And I had never heard of it before. And I'm sitting there complaining about, how hands-on my real estate is and how hard it is to scale, and asking them what they would do. And that was basically the answer. So I started to switch gears over the next 18 months, started to offload a lot of those single family properties, and transition to being a full-time passive investor. And ever since, I've been educating other people that are looking to do the same, which is be a little more hands-off in real estate. So partnered up with Joe Fairless at Ashcroft Capital in 2019. And now I do a lot of educational speaking events, on stage, webinars, podcasts, nationwide, in-person workshops. I do a lot of stuff. So to me, that was, kind of the point was to back up a step. First, leave a job I didn't enjoy or like, which was oil and gas work. I did that through single family homes with my cash flow. And then it was to basically be more hands-off so that you have a work optional lifestyle and that you can pursue things you're actually interested in or passionate in. And that's what I help coach other people on today.
That's huge. And that is, it's almost the mystery of the passive income concept. It's because people buy real estate and they feel like they need to manage the real estate and do this and that, and it kind of turns them off. But knowing that there's another option of having your investment holdings in real estate, getting the tax benefits, and not needing to manage the toilets, the tenants, and the termites, so to speak. It's a totally different concept, and it's great. How would you think that your background and experiences have contributed to your success in the real estate industry?
That's a great question. I have to laugh because my background really makes no sense on paper. I went to college out in Florida to do live show production. I wanted to tour with bands. I was in a band. I was a drummer. I was a singer. And I thought, man, I want to be in the music scene, going nationwide and international tours. Quickly got out to New York City, started working some off-Broadway theater stuff to get my foot in the door, and realized this is not an industry I want to pursue at all. So backtracked to Colorado, where I was raised, and went into oil and gas and started working my butt off, 14-hour days, 98-hour work weeks. I worked in Saudi Arabia. I worked in Wyoming in freezing cold weather. And I realized, man, I hate this too. I don't want to do this. And so I think, the takeaway from all this stuff, I worked a bunch of menial jobs in the process of this stuff. I made a lot of income. I made no income. And I worked in all kinds of sectors, was ICANN is more important than IQ. I've never seen myself as a very smart individual, but I do have a lot of willpower, a lot of drive, and to the point of your show, a lot of hustle. And that's why I started with that in the opening. I do think this industry requires some hustle. Even as a passive investor, you're going to have to educate yourself, listen to podcasts, read books, get a fundamental understanding, maybe get a coach or a mentor to get started. And, you're going to have to put yourself through that. This is not something you're taught in school, or most often not taught at home either. So willpower, drive, hustle. That's my answer.
Yeah, I think that your point that you just made, you have to educate yourself, and I think that that is one of the most rewarding parts of this industry. Is that in order to be a part of the club, you have to educate yourself. You can't buy yourself into the club. You can't just walk in. And the club is other real estate investors talking knowledgeably about the industry. There's
Yeah.
terms and there's a language that you have to know and understand in order to talk knowledgeably about it. And the only way to get there is to self-educate. And that's the rewarding part about being a part of a very rewarding industry. What are some common misconceptions or mistakes that investors make when they first start exploring passive real estate investment opportunities?
Yeah, well, a couple were, I remember thinking the first time I saw a pro forma, which is basically just projections on what a deal might potentially do, I was very skeptical because I was coming from the single family space where I did everything myself and I knew what my returns were from cash flow and IRR. But as I'm seeing this and thinking about it from the standpoint that I would be hands off, I would be a passive investor, and you're saying I could basically get the same returns, maybe even better returns than I'm doing now. It sounded like a scam. It sounded too good to be true. So, I took it slow. I did one deal. I gave it 6 months to make sure I wasn't getting taken advantage of, made sure the distributions were coming through, the reporting was happening, visiting the property. And that really opened up my eyes between those two mentors that have been doing this 20 years, which I fully trusted as individuals, and then doing it myself and putting some skin in the game. So don't be too skeptical. The other thing is be realistic. A lot of investors just think that, the market never changes. When I got started in 2015, it wasn't uncommon to get cash flow at 8, 9, 10% year number one and get a 25% IRR on the back end. Well, times change, markets change. So today you're looking at maybe a 4, 5, 6% cash flow instead, nearly half. And the IRR is probably going to be potentially lower. So to me, the deals still make sense, or else I wouldn't do them. Value add real estate's always been the core and the foundation of my portfolio, because I love having that option to force appreciation into something and not have to just be reliant on the market to do it for you. And real estate is essential. I mean, depending on what sector we're talking about, I like, residential housing the most, and we're just undersupplied. That's the bottom line. People have to have a place to live. Multifamily rental real estate has been around for thousands of years. It was written about, back in the ancient Roman times,
Yeah.
So, we're in a deal and we're out in 3 to 5 years. So if you think it's going away in that time frame, that'd be a little bit crazy to think that housing gets outsourced. So
Do you
anyway,
think that those returns coming down, is that a part of these institutions just coming in so heavily and running up the numbers?
It's a combination of a lot of things. It was a combination of really cheap debt, historically speaking, where people are getting debt for almost 0%, almost nothing. So that gives borrowing power to anybody and everybody. Commercial real estate lending, it's based off the property, not the individual. So as long as you're finding and underwriting a cash flow positive property, then there's a lender out there somewhere. It's a lot of these coaching and mentoring programs that have popped up over the last 5 to 7 years. They've probably gone 10x with conferences and boot camps and training. So a lot of students entering the space. And then to your point, a lot of institutional interest, like with Ashcroft, we sold last year in 2022, 9 deals to, it was a Goldman Sachs partnership. And, there's just a lot of people interested in these larger 200 plus size apartment communities, on top of being undersupplied by, over 1 million homes nationwide in the affordable housing sector. So it's kind of like the perfect storm for, bidding property prices up and things like that. So
But
Yes.
the positive is you can still look, feel, and touch it. It's an investment that, in my opinion, there's somewhat control over because people still need housing. It's not the stock market where
Yep.
a news headline can drastically change your portfolio value. Totally, I agree. What do you find most rewarding about the role as director of investor education at Ashcroft Capital?
That's a great question. Before I dive into that, I want to hit on one more positive on the multifamily this year in 2023 is the Fed went historically, strong with these interest rate hikes, right? Unprecedented, time frame and rate hike frequency. So we're nearing the top right now, which has caused a discount in pricing. And so that's kind of the silver lining to right now is the Fed suggesting maybe they're going to be either tapering off down the road or at least pausing and seeing what happens. And if they do raise rates, it's going to be very menial and incremental compared to what they did in 2022. So it's a time to buy the dip and to underwrite with the expectation that the Fed keeps raising rates, even if they don't. And if they taper rates or reduce them, that's going to be everybody's best bet, And so I'm a little more bullish this year than I have been, frankly, in the last 2 or 3 years. And so if you're buying new deals today, so something to think about for anyone looking to get into the market now or think maybe we're in a recessionary period, maybe I'll wait and see. Just keep that in mind. The interest rate cycles pretty much come to a conclusion. So,
and I'm glad you said that because that is the great unknown is how high will they take this thing before it just breaks. But you feel like it's starting to stabilize and plateau off, and that's encouraging. That really is, that's encouraging because now maybe we are in a buyer's market to where there are. I don't know about discounts, but I think seller expectations are coming in line with and what their property is actually valued at an in-place NOI, and that's I think still high. And I think that's going to be there no matter what in any condition. But that's very encouraging that you're saying that the Feds are, it feels like it's going to start normalizing maybe or even come down.
Yeah, well, I look at that stuff a lot. So you got the FOMC, the Federal Open Market Committee, basically the chairs and the board of the Fed, and what they're saying and expecting. Then you've got the Fed funds the Fed futures expectations, which is what the market is saying they think the Fed's going to do. And then to your point, if something breaks in the economy, a full-blown banking crisis or whatever unfolds, the Fed's other obligation and job is to save the economy by reducing interest rates drastically down like we saw in the COVID era to help stimulate the economy. So it's kind of like no matter how you spin it, this is a much better market to buy in 2023 than 2021 and 22. So just to your point.
Totally. Are you all looking for, I think I've got the answer to this, but bridge debt versus, say your agencies, your long-term, or are you looking for the short-term or a long-term on your debt?
Right now, what we're doing is we're looking for about 60% LTV on our deals, and we're looking for about a 5-year fixed rate term. And usually and historically, we'll hold a deal between 3 to 5 years, mostly closer to that 3-year mark. So that has changed where we did have some floating rate debt, but we had interest rate caps on it, of course, in previous years. But that's still been problematic for a lot of groups because it's hard to know and predict and have a crystal ball. Of course, this gets back to your LPs getting realistic. In 2018, the Fed said, we're going to start raising rates, and they started doing it. And then they stopped and they tapered them right back down. And then we moved to 2020 and they cut rates down to 0. Right. And then they start saying, now we're going to raise rates again. A lot of people didn't believe the Fed. They say, yeah, right. You never do that. You say you're going to do it. You can't do that. Well, they did it. So a lot of people with these 1 and 2 year arms on their floating debt are having to pause and reduce distributions and things like that in the current year to reset their debt structure. So anyway, I won't get in the weeds about all that, but it's a healthier market today than what it was before. So to your question, Josh, about director of investor education, I came on board first with Joe Fairless and Ashcroft to do Director of Investor Relations because that's what was needed as a company. So hired Evan Pulowski, who now runs the Investor Relations arm and has different consultants underneath him. So that was kind of the first stage of it, is help build the infrastructure for what's needed as the company. I was finally able, thankfully, to move over to a position that I've always wanted to have, and that's educating and reaching people through networking, through conferences, being able to travel, being able to give back my time to others. And that's what it's all about. I've always been that person, even as far back as high school, before my real estate days. I wrote a little book for my senior class, not to sell it, not to make money, not to get popular. It was just how to improve your GPA basically in high school, because I had found what I thought was some useful, tips and tricks and strategies that I used that made a difference. And I just wanted to help other people. So what Ashcroft Capital has allowed me to do is reach a much wider audience base than I could otherwise do on my own. Okay, to get access to larger events and things like that. So it's a real win-win. I've been an investor with Joe and Ashcroft for years and years. I'm in a lot of their deals. My family's in their deals. So it's a group I can support and back and speak to. At the same time, it's a personal fulfillment for me and a mission that I'm trying to accomplish. So it's been extremely rewarding, and I'm thankful to be in this position under this title that I've been working towards for many, many years.
So that's huge, and you add to you're a pillar of your organization now. You're you're managing one whole piece of the business, and it takes business leaders like yourself to make a organization successful. So it's about having the right people. Can you share some of the key principles or strategies that you believe are essential for successful hands-off real estate investing?
A lot of us are taught, Josh, that investing is buy low and sell high. It's buy a stock at $10, and if it goes to 15, then sell it and you make a profit, or put money in your 401k and hopefully that grows over time. This is all about appreciation, equity, net worth. I started to reverse engineer that whole system many, many years ago, even before I started investing, into thinking about cash flow and passive income, because that's what can really free up your time. That's what can really expand your lifestyle. And I started thinking about this and well, it was before 2015, but 2015 is where I was really taking action in a big way. And I thought, just hear me out on this. For some simple math, you say, okay, I'm trying to build financial freedom, financial independence, and my lifestyle expenses are $100,000 per year. That would cover my bills and my rent or my mortgage, just for simple math. So I started thinking about, well, if I had $1.25 million invested and I got an 8% annualized cash flow yield, then that would give me $100,000 per year. And that's not even factoring the equity upside potential if you're doing value add real estate. So in theory, that's kind of like your inflation hedge and, covering taxes and kind of the icing on the cake, the equity. But the cash flow is what you're really living off of. And you're not having to sell the golden goose, right? You're not having, like, a lot of people will dump money in a 401k till, let's say, it's $1 million in retirement. And then they start chipping away at it. They start selling, 40, 50K a year out of it, selling off their nest egg to support their lifestyle. This is protecting your principal 100%, your original money that's invested, and just living off the passive income streams, and then using the potential equity upside to offset taxes, inflation, and miscellaneous times that maybe you're out of the market or not investing. So I've created the 8% rule for myself. That's never advice for other people. That's just what I've done since 2015. And we spoke about new deals in 2023 having lower yield, but you have to remember too, I have older deals that I did years ago that are now cash flowing at 12, 13, 14, 15% annualized, but maybe a new deal I do today is 6%. So I'm trying to average conservatively about an 8% yield per year. And that's what I've used as kind of my metric. Again, I'm not, don't have the largest IQ out there. I just found a simple strategy from a macro level that works for me, and something to think about. And think in terms of passive income versus, just equity, just flipping a house or trading stocks or what have you. It
Yeah.
just made a huge difference in my life.
That's huge. And your depreciation. I know bonus depreciation is going away, but that just adds to the matrix of returns. It's
It
all
does.
there.
I didn't get into real estate for the tax advantages, but I like to joke and say I stay in real estate for the tax advantages.
Yeah, it's there's just so many good qualities and things that it's like everything offsets everything to the investor's advantage.
Yeah.
It's so can you talk a little bit about Linda's Legacy Industry Impact Award you've received in 2022 and what it means to you?
Yeah, so that was awesome, man. Totally blindsided by that. Apparently, I had been nominated. This is part of Think Realty for an Industry Impact Award. And what it comes down to, Linda was an individual who just, like myself, gave her time back to other people, changed the way that the conversation was going industry-wide in terms of investing. So I launched a show a couple of years ago called Passive Investor Tips on under Joe Fairless's Best Ever Real Estate Investing Advice podcast. It's a once a week little segment subcategory of the show. And the whole point was I said, okay, there's a lot of people in our society that are just out there to make a buck, right? They're trying to just make money in any way they can. So I said, I want to build 100 episode series of training passive investors in 5 to 7 minute consolidated episodes, no fluff, right to the point, tips, tricks, strategies, formulas, etc., and stories that I share. And the idea is that you would listen to 100 episodes and essentially know basically everything you need to know about getting started as a passive investor. And I want to do that for free. I don't want to have any personal benefit. I don't get paid to be a podcast host on his show. I just want to do this because I would be proud to make that for people instead of trying to charge someone $5,000 for a course or something like that. Nothing wrong with anyone doing those strategies. That just wasn't, where I was at when I decided to do this show. So I think that had a lot to do with it. I get comments daily, through social media, Instagram, Facebook, LinkedIn, about people tuning into that show and finding it rewarding. And I've just tried to change the conversation. I talk about, how does stoicism play into being an investor? Who else is talking about that stuff? So I'm not just covering what's happening in the economy and the banking crisis and what interest rates are doing. I'm trying to build personal stories and, bring in things that people haven't thought about before. The rule of 72, how to, effectively double your money, the 8% rule that we spoke about, things like that. So go ahead.
I was going to say things that people are not just, they haven't discovered yet, and you're making them aware of them. There's little tricks.
I love thinking outside the box, man. That's what keeps me up at night. And that's why I get such crappy sleep. I'm always trying to think of some new creative spin or something to do that no one else has thought of. So, yeah.
It's connecting the dots and discovering the new tactics, and they're there, and it's there for everyone. And it goes back to the teacher will appear when the student's ready to learn, and you're there teaching exactly what they need to know. How do you stay up to date with the industry trends and developments, and how you ensure that your investment strategies remain relevant and effective?
Yeah, it's a good question. So basically, every quarter, I'm reading through because I have to do, different reports and blogs and articles. And I assist in a lot of things that Ashcroft does from a reporting standpoint. And I used to run a show called Multifamily Market Report, where I would get on weekly and talk about updates and stuff. But anyway, long story short, every quarter I'm reading the Marcus and Millichap, the CBRE, the CoStar, the Urban Land Institute. I mean, the list goes on and on. There's probably 10 different sources. And what I'm trying to do is read all 10 of these and find the commonalities. Where do all these groups agree? All right. Because everyone's going to have an opinion, and you're going to read a lot of different statistics and metrics. But if all sources are saying basically the same thing, like projected rent growth is going to be 3 to 5% annualized in the multifamily space, then that's a metric I really pay attention to, because basically everybody is predicting that. And I try to shy away from the extremisms that you see on, CNBC, where it's like, hey, we're in a new bull market, things are going to be great, and then, oh no, it's about to crash 40%. Watch out, it's happening next month. I don't read crap like that.
Yep, and there was one just, I think it was last week, a very prominent multifamily investor came out with it was a interview, and man, the walls were caving in or getting ready to, and those are the extreme. It's what you just said. What are the commonalities? What are the where's the balance at?
Yeah.
Totally get it. As a public speaker, what are key messages that you aim to convey to your audience, and how do you tailor those presentations to different types of investors?
Ooh, that's a really good one. So, I'm fortunate to do a lot of different types of speaking events. So next month, I'm heading out to North Carolina, and I'm speaking to physicians at a physician conference, right? And I just got back from Tampa doing an educational workshop about how to build passive income through real estate. And we didn't just talk about syndications. We talked about REITs. We talked about individual ownership. We try to do the whole spectrum. And then, I do all these individual podcasts and strategies and tips. So the bottom line is, what I would love for people to take away from my message, no matter what source you're tuning in from, is, to your point earlier, Josh, it doesn't have to mean that you're a landlord or that you're a house flipper if you want to get into real estate. It doesn't. Okay. And it doesn't mean that a syndication or a private placement is the only thing out there that's passive. You could buy publicly traded REITs. You could buy public REITs. You can do different strategies. You can hire property managers. I just want people to realize, because I remember one of the people I first, idolized when I started thinking about investing in money, I was probably roughly 18 years old, maybe 17, was my grandfather. And he was a stock guy. His whole life was stocks. All he would talk about is stocks, and how I needed to open a Roth IRA and buy stocks. So I said, as a couple of years had passed, I was into real estate by age 20. So this was probably around 21, 22. I remember talking to him on a visit over Christmas, and I said, have you considered real estate as kind of a diversification? And he goes, oh, no. He goes, I will not manage tenants or toilets. I'm against that, and that's always going to stick with me, because, the more I've educated myself in this space, it's like, man, it didn't have to be that way. And I didn't have a good comeback for him at that time, to say, well, you could do a private placement or a REIT or whatever. I had no comeback. I just thought, oh, that's a good point, because I was suffering from the same thing myself in real estate. So just know a lot of options exist. And then to try, like, here's the last thing I want to say about this messaging. There's a big difference between rich and wealthy. And a lot of people in our culture are after rich, and rich has to do with income. And, you make $1 million a year, you're a business owner, you're a celebrity, you're an athlete. Okay. It's all about money coming in. So it's income, but wealth is about assets and passive income. So I would rather have next to nothing in terms of net worth, but be wealthy because I had more passive income every month than I had living expenses coming in. You know how, like, if you win the lottery, you can opt to have that paid out over years, and kind of that guaranteed income stream every year. That would be me opting for that, and not the big cash out and paying 50% tax up front. So, wealthy is really, you have more passive income than you have living expenses. And rich, I've never envied, because just because you make $1 million a year, 100,000 a year, or whatever, if you spend it all, you're broke.
Yeah.
If that income stream goes away, you're done.
Yeah.
If you can't get your next acting gig, if you get injured as an athlete, you name it. This happens over and over again. The statistics are crazy that these pro athletes are going broke roughly 5 years after retirement, in the 70% range. It's insane. Lottery winners, same thing. So focus on wealthy, not being rich.
Well, and if they do have a great transactional income stream, use that stream and put it into your
Yes.
passive income streams. I mean, it's a great tool to have, but just like you said, understand you only make that money one time, and then you got to go out and find it again and again and
Yeah.
again and again. So, awesome conversation, Travis. We truly appreciate you having coming on the show today. If somebody wants to learn more about yourself, invest with you, or get educated, how can they get a hold of you?
Sure. So I'm on Instagram and Facebook at Passive Investor Tips, which is the name of my podcast as well. And I'm on Bigger Pockets and LinkedIn and Ashcroft and everything else under Travis Watts, WATTS. I put my calendar out there, Calendly out there for anyone that wants a free 15-minute phone call, no upsell. I don't have books, courses, or anything to sell you. You just want to have a chat about passive income. You can go to ashcroftcapital.com/Travis and book a time there. And I'd be happy to connect and add value in any way I can.
Perfect, Travis. And we'll send your contact information out when we post this as well. So definitely appreciate it. And we'll talk soon.
Thanks, Josh. Thanks,
All right.
everybody.
Thanks, Travis. Bye.